Good morning. My name is Erin Eldridge. I would like to thank you for being here today. I'm in the Capital Markets and Institutions course with Professor Igor Glisick in Concordia University Masters of Business Administration program. Today I will discuss the financial analysis I performed on TD Ameritrade. To further assist me in presenting the information to you, I will use my PowerPoint presentation for reference. I will speak during the presentation as the CEO of the company, offering suggestions on how to save and redistribute money. This timeline reflects a long-term strategy based on financial analysis of current performance, which will accomplish TD Ameritrade company goals. This is a 10-year strategy for improvement of current finance shortcomings. This is a snapshot of the strategy based on the financial analysis and performance solution recommendations made because of the analysis. I will further discuss how I came to these conclusions in the slides ahead. As can be seen, this is 10 years, so starting from today, where we will focus on the current situation and decide which steps to take next, and then finally in 2028, continue to grow the company in alignment with our goals. It was imperative to perform financial analysis of the company to further understand the current performance, identify weaknesses, and determine a strategy to improve. Financial analysis is the process of selecting, evaluating, and interpreting financial data in order to formulate an assessment of the company's present and future financial conditions and performance. This can be accomplished by taking a closer look at market data, financial disclosures, and economic data. Since we have yet to see financial data from the first quarter of 2018, the current performance analysis will be done using 2017 figures in comparison to the past 5 years of data. The figure seen here illustrates TD Ameritrade's net cash flow numbers since 2013. Cash flow is the amount of cash and cash equivalents entering and leaving the business. This is the money that is actually available to pay expenses and make investments. 3 values are represented in this figure: net operating cash flow, net financing cash flow, and net investing cash flow. The operating cash flow shows whether the way the company creates and manages its earnings provides sufficient cash to cover all operational expenses. When operational cash flow is negative, a company must generate positive cash flow from its financing and investing activities. Financing cash flows are generated from obtaining new debt, selling stocks, retiring debts, or paying dividends. Investing cash flow is generated from selling company assets or purchasing equipment or property. As can be seen in the figure, the net operating cash flow, net investing cash flow, and net financing cash flow all had positive and negative numbers over the past 5 years. This data is particularly pertinent to the bottom line figures of the company. The blue line represents net operating cash flow from 2013 to 2017. This value had the greatest fluctuation over the course of 5 years, having a negative $996 million net operating cash flow in 2017 is cause for concern because when the number dipped below zero, the company was no longer able to cover operations from running the business. However, this can also signify company growth, which the company was in fact undergoing. To help balance out the negative operating cash flow, the financing cash flow was a positive $477 million. But once again, it is cause for concern that the net financing and investing cash flows do not exceed the negative operating cash flow. The net investing cash flow was a negative $1.6 billion for the year, meaning the company was operating in an overall deficit of $2.1 billion for net cash flow for the year, in comparison to other years where the lowest net cash flow was positive $140 million in 2013. As previously mentioned, the net operating cash flow was negative for 2017, which was due to rapid growth of the company. The net property, plant, and equipment value for 2017 was $230 million, more than the average values for the previous 4 years, indicating expansion of operations. This expansion contributed to total company assets, but also contributed to overall debt. This figure illustrates the proportion of assets from 2013 to 2017 with respect to the total assets. This figure shows how the company distributes assets to make up the total. The majority of TD Ameritrade's assets are from accounts receivables. We can see in the graphic that the company maintained and valued similar assets from year to year. This figure illustrates company total liabilities and proportion of liabilities from 2013 to 2017. Total debt and deferred taxes are minimal in comparison to other liabilities. This figure shows the progression of total assets to total liabilities from 2013 to 2017. The positive incline with respect to one another is a good sign, indicating a steady liquidity ratio, which is assets over liabilities, from year to year. The shareholders' equity determines the financial health of the company because it is total assets minus total liabilities. This value can be positive or negative, but when positive, it means that the company has enough asset value to cover its liabilities, whereas if the value is negative, the company has debts to outweigh assets. This figure demonstrates total shareholders' equity from 2013 to 2017. Values from year to year all show positive returns, with an increase each year and rapid increase in 2017. Financial ratio analysis is the final component to analyzing company performance over the past 5 years. Liquidity ratios determine the ability of the company to meet short-term obligations. Activity ratios determine the effectiveness of asset investment. Solvency ratios determine the ability of the company to satisfy debt obligations. And profitability ratios determine the ability of the company to manage expenses to produce profits. The table and figures seen here break out liquidity, activity, solvency, and profitability ratios of the company data from 2013 to 2017. The current liquidity ratio determines the ability of the company to satisfy current liabilities using current assets. The asset turnover ratio determines the extent to which total assets creates revenue during the period of interest. The debt-to-asset ratio determines the proportion of assets that are financed with debt, and the cash flow to debt ratio describes the length of time needed to pay off debt with cash flows. Finally, the profitability margin ratios determine the portion of revenues that make up profit. Without doing any financial analysis on the company, it is clear that TD Ameritrade's strengths all revolve around people. The company provides guidance, powerful training tools, and retirement resources. With straightforward pricing without surprises, education for smarter investing, independent third-party research for market insights, and easily accessible customer support, it all helps the customer trade and invest based on their desires to diversify their investment portfolios to take care of their families. These strengths will keep customers coming back, but there are currently some serious weaknesses in the company that, if given the chance to fester, will threaten the livelihood of the company. The first weakness observed in the overall negative net cash flow for 2017. The net investing and net financing cash flows did not balance out the negative operating cash flow, meaning the company was operating in a deficit. With positive cash flows from previous years, the company was able to stay afloat. But with this type of performance, the company will not last several years. The second area of concern is the negative cash flow to debt ratio. With such a huge negative number, the company is not able to support its debt obligations from operating cash flows. Net cash flow is one of the performance solutions that we're going to talk about first. If growth is the goal. While growth is a necessary component of developing a profitable business, It must remain on the back burner if the company does not have enough money to perform day-to-day operations. Healthy growing companies will pursue suitable debt or equity financing in advance of its needs. When operational cash flow is negative, a company must generate positive cash flow from its financing and investing activities. In order to improve financing cash flows, the company must obtain new debt, sell stocks, retire debt, or pay dividends. Investing cash flow can be generated from selling company assets or purchasing equipment or property. Next, cash flow to debt ratio. The company can take steps to reduce and improve debt to capital ratios by increasing sales profitability, managing inventory better, and restructuring debt. Increasing profitability can be done by raising prices, increasing sales, or reducing costs. The additional income can be used to pay down existing debt. Better inventory management can be achieved by maintaining a lower amount of inventory as to minimize the amount of working capital tied up. Finally, restructuring debt is a way to increase capital and reduce the debt to capital ratio. This can be achieved by refinancing high interest rates with lower rates, reducing both interest expenses and monthly payments, and improving the company's bottom line profitability and cash flow. Capital structure is how the firm finances its overall operations and growth using different sources of funds. Debt is in the form of bond issues or long-term notes payable, and equity is common stock, preferred stock, or retaining earnings. Determining performance of the company not only requires financial analysis, but also requires market analysis. One of TD Ameritrade's major competitors is E-Trade. These are the two most active stocks in investment brokerage. Ameritrade is expected to grow earnings at a 17.73% annual rate over the next 5 years in comparison to E-Trade at 14.7%. The growth of a company is irrelevant if profitability is low. Ameritrade is more profitable than E-Trade with an EBITDA margin of 88.07% versus 50.07% for E-Trade. The return on investment is 13% for Ameritrade and 1.4% for E-Trade. Ameritrade's free cash flow per share over a year was negative 2.79 versus negative 4.37 for E-Trade, meaning that Ameritrade generates more free cash flow for investors per sale. Ameritrade falls short, however, for the debt-to-equity ratio at a measly 0.47 compared to E-Trade's 6.69, meaning that Ameritrade is less solvent and less able to meet short-term obligations and long-term debts, therefore considered a higher risk company. The price-earnings ratio values the company based on current share price to its per-share earnings. The price-to-book ratio compares the stock market value to its book value, and the price-to-sales ratio is the valuation ratio that compares the company's stock price to its revenues. Ameritrade is valued at a P/E of 23.75, a P/B of 4.71, and a P/S of 7.28, compared to E-Trade's P/E of 17.34, a P/B of 1.89, and a P/S of 5.57. Even though Ameritrade is the more expensive of the two stocks, it is the more desirable company to investors. However, cheaper stock does not mean more value. The current price needs to be compared to where it is likely to trade in the future. Ameritrade is currently priced at 0.72% to its one-year price with a target of $48.33, whereas E-Trade is negative 4.93% relative to its target of $45.40, which suggests E-Trade is the better investment over the next year. E-Trade also shows less volatility and therefore less risk than Ameritrade. Overall, TD Ameritrade is the better of the two stocks for its growth, profit, and return on investment, cash flow per share, and lower financial risk. To truly be the number one company, Ameritrade needs to solve the debt-to-equity problem, and the company is successful in growing, but cannot meet basic obligations while expanding. Even though expansion will improve overall profit in the long run, it is increasingly more important to be able to pay for short-term responsibilities. Debt to equity is the relative proportion of shareholders' equity and debt used to finance the company's assets, indicating the measure of the company's financial leverage. With higher debt than equity, the company faces some potential financial struggle in the short term. Looking to the future for growth is healthy, but only if the company can survive in the present. Here are some recommended debt reduction strategies. Increase profitable sales, reduce overhead, monitor inventory, restructure debt, sell assets and lease them back, or take on a partner investor. Capitalization is a method that can be used if the company sells assets and wants to buy some back, but expenses them over the life of the asset. This allows debt to be incurred, but allows the company to spread out the full price, reducing a huge hit on equity. As a publicly traded company, Ameritrade can issue more company stocks to add equity. The final option for raising needed capital for the company is to issue bonds, which functions as a loan between the investor and corporation. This would bring in interest payments over the life of the loan, which are more attractive to the borrower because the interest rate would be less than banks charge. Bonds give the borrower financial freedom to operate as they see fit, while giving Ameritrade no strings attached capital to pay down their debt. In order to satisfy funding needs, Ameritrade could proposition government agencies for financing such as grants and subsidies to expand the company. Another method would be to merge, acquire, or be acquired by another company, combining or transferring operating units, allowing both companies to grow, shrink, or change in nature based on their needs. The weighted average cost of capital is a calculation of the firm's cost of capital, weighing each component equally. The WACC of TD Ameritrade is 12.02%, and the return on invested capital is 14.93%, meaning that the company generated higher returns on investment than it costs to raise capital needed for that investment. The company is earning excess returns. The value of the company will increase as it continues to grow. With growth will come additional investor wealth. In conclusion, the financial analysis of TD Ameritrade reveals that the company is performing well in comparison to major competitors such as E-Trade, but is performing worse in net cash flow and debt to equity from previous years. This is due to major expansion of the company, but it is vital to the health of the company that it be able to successfully fulfill short-term financial obligations so it can focus on growth in the future. The company is in great position that if it can bring down the debt in relation to equity, investors will gain wealth and the company will remain as an industry leader. Here are all my references if you'd like to view them. Thank you so much for your time today. I will take questions now. If there are none, have a wonderful day, and thank you so much.